everyone. Good evening. Thanks for your time today. My name is Gabriel. As Roland said, I'm one of the managers of Asia Focus. We are an investment trust that the sole purpose is to invest in a portfolio of listed smaller companies in Asia. In terms of how we approach investing in Asia, the first thing I'd say is that we have a very long-term perspective. We see ourselves really as partners of the companies we invest in, some of which we've invested for over 2 decades, and not really traders of stock. We have a very experienced and large team in Asia, about 40 managers across the region in China, Hong Kong, in Singapore, Thailand, Malaysia, as well as Japan and Australia, although Japan and Australia doesn't really fit into Asia Focus in particular. We think we focus on the highest growth region in the world and the smallest segment of the market where coverage is pretty poor. So we're really trying to find the hidden gems in Asia that will become future winners. We have a concentrated portfolio of about 50 companies. We think that we can select the best quality companies we can find out of thousands of small caps in Asia. So again, we think that that concentration is important and that focus on quality is very important as well. The end result is we think we have a very differentiated portfolio from what else is out there, particularly when you look at other mutual funds in Asia, which are focused more on large caps and the big tech companies in China, for example. Just to remind people about the structure of investment trusts, unlike mutual funds, they have a fixed capital structure, and the advantage of that is that you're never really a forced seller of stock. It means that you can be a long-term shareholder for the long term in these companies. It also means you can add a bit of excess return by gearing, even though we are very conservative in gearing, and again we have a focus on quality companies which we think are the most resilient businesses in the region. Quality can mean different things for different people. For us, I'd really characterize it as 3 things. One is having a good governance structure and management team, people that you can trust, that have a good track record. Secondly, and perhaps even more importantly, is a business that is differentiated, has sustainable profitability and margins, and can survive any economic cycle. Finally, again, in a similar vein, we like companies that are not aggressive with debt and have a strong balance sheet. So our portfolio is net cash, which means our companies are sitting on cash rather than having debt. This is just a slide, a bit of a promotional slide in terms of performance. I think performance over short-term periods can swing quite a lot relative to benchmarks, but over the long term, we hope that we can beat the small cap benchmark, which is the closest benchmark that comes that we can measure ourselves against, even though we're very, very different to the benchmark, and I'll come on to that later on. So why people should bother with Asia small cap? I think the first question is really why Asia. I think you'll have heard this many times before. But Asia is the fastest growing region in the world. It already has over 50% of the world's middle class, and expectations that 2/3 of the world's middle class will be in Asia in 2030. This is not just a China story. There's a lot of growth in India and lots of demographics. I think India this year surpassed China in terms of demographics, a much younger population. Countries like Philippines, Indonesia also have at least 200 million people each. And the next billion middle class people in the world, 90% of those are probably going to come from Asia. So again, a very powerful theme and structural growth story that we're playing into here in trying to buy these companies in Asia. Again, this is quite an interesting slide that I thought I'd include just in terms of consumer surveys on health of economies or perceptions from the consumer, local consumer, on how they feel about economic growth post-COVID. And you can see that in places like the UK and Europe and Japan, people are quite pessimistic about the outlook for the economy. But despite all the headlines, the consumer in Asia is actually really positive. We can debate China because China is going through quite a difficult period at the moment, and this is 2022 survey, so things might have got a bit tougher there. But in somewhere like India, only 2% of people feel pessimistic about the economic outlook, which really tells you, these people are excited, they're spending. Affordability for things like property is the highest it's ever been in India, despite all rising interest rates globally. Why small caps? Again, this is, I think, something you'll have heard before, but they're typically under-researched, so that means there's more inefficiencies in the market in pricing these businesses. over a third of companies in the small cap space have less than 3 analysts covering it. In the large cap, it's less than 10%. So that should be relatively straightforward. And also, if you look back in terms of large cap versus small cap, the dispersion of returns tends to be higher for small caps, just means that they can perform better. They all can go down to 0, but in terms of getting that extra return, small caps tend to perform better. Obviously, you're hoping you get these businesses here at the top rather than the bottom ones. Not always the case, but that's the intention here. And then the final point is really diversification, where if you're just investing in large cap, you're only capturing a portion of the market, certain sectors. Whereas if you invest in small cap, if you look at the index, which is not necessarily a fair representation, but you'll have much lower financials, for example, versus large cap, and you'll have more in industrials, in healthcare. So those are differences between small and large cap. Again, this is just to show how Asia Focus has performed relative to a large cap index. So there's a lot of talk about today investing in ETFs and passive. But if you look at this is since the trust started, so again, a very long-term period. But if you look at that slide, it shows you that actually by combining Asia Focus with a passive allocation, you start to actually enhance returns. So returns are on this side, and you reduce the risk if risk you measure it by volatility. In terms of the debate around large cap and small caps, a lot of people perceive small caps to be higher risk. Over the last 3 years, it's quite interesting. This hasn't been talked about too much, but actually small caps have been performing much better than large cap in Asia. Almost 40% difference over 3 years. Part of that reason is really China, because China is a much bigger representation of the large cap index than it is in small cap. Again, if you had allocated to small cap over large cap, you probably would have done a bit better over the last 3 years. The other misconception, I think, is that people will always bunch up Asia and emerging markets into one, but they are very different places, and they perform differently as well from an equity market perspective. So you can see here, this is over the last 1 year rather than 3 years, but you can see that China has been quite weak in terms of one of the larger markets, whereas the other larger markets like India, Taiwan, and Korea have been quite strong. India is in a bit of a sweet spot. We can talk about that later. And Taiwan and South Korea have been benefiting from the AI rally, a bit of positivity around tech, given a lot of the supply chain globally is in those two countries. If you looked at this over 3 years, you'll see that actually Indian small caps have doubled and Chinese small caps have been down 40% or so. So that difference in performance is pretty stark. In terms of our positioning and portfolio characteristics, we feel that being diversified is pretty important, partly for the reasons I've just mentioned in terms of there is differentiation. These markets will perform differently over time, and different sectors will perform differently over time as well. So we don't want to put all our eggs in one basket. We have India has always been one of our favorite markets. It is quite expensive at the moment, but so we're quite underweight relative to the benchmark, but it is a favored market for us in a place that we'd probably want to allocate more if we could. We have historically been quite low in China. So China in a large cap benchmark is probably around 30%. We had close to 0 about 18 months ago. So we've been allocating a bit more to China as that market has come off. But we have a big allocation to Southeast Asia as well. So places like Thailand, Singapore, Vietnam, Indonesia being our largest actually in Southeast Asia at around 11%. And then from a sector perspective, IT has increasingly become quite meaningful in the portfolio. It's quite diversified. There's the semiconductor companies, the supply chain there, which is, again, quite meaningful part of the universe, but also there's IT services companies and also software businesses. So again, tech has become, is pervading really all sectors, but in terms of our exposure, tech is about a quarter of the portfolio. We have historically been quite light on more cyclical areas in materials and energy, but we do have some exposure to energy, including in our top 10 there, which is, again, quite diversified. It has IT, a bank, a couple of energy companies, industrials, a conglomerate, healthcare business. And you'll see over here that we've held in our Aberdeen portfolios and in Asia Focus, we've held them for a mix of decades and some for about 5 years or so. So again, we are long-term shareholders in these businesses. We spend a lot of time engaging with the management teams, with the board. And you'll see again that our weightings relative to benchmarks are, it's completely different. So there's a measure called active share, which measures your difference versus the benchmark, and we're 98%. So because small cap is, the companies are a very small representation of the benchmark. So again, less than 1% of the benchmark is our top 10. I'm probably running out of time a little bit. I think I'll just rush through these. I think this is just an example. This is our largest company in the portfolio at the moment. It's a company called Park Systems in Korea. We've invested in it for about 4 years, and you'll see that it's performed extremely well for us, which is the reason it's our largest position. It's a good example of what we try and find in Asia, which is a leading business in their field. So they're creating a new field, which is basically very powerful microscopes, which they're using for things like semiconductors and biotechnology. The founder who founded this business, he went to Stanford. He worked with the creator of this technology who won the Nobel Prize in physics. And he has been, bringing this application, these equipments to the industrial world rather than the research and academic world. So this is a very profitable business, very innovative, spends quite a lot on R&D, has a net cash balance sheet, and still has a very long-term runway for growth. So, I think that's a good example of what we like. This is a company we introduced recently. It's a Chinese business. It's equivalent of Auto Trader here in the UK. So it's a car platform business. It has the equivalent of the UK population as daily active users. So it's pretty big business. Although, at the valuation at the moment, 90% of its market cap is just the cash sitting on its balance sheet. So that's an example of how mispriced some equities, some companies have become in China. It's profitable. It generates good cash flow. It had been through a period of tougher competition, but we think it's going to remain a leader in that market. And it's well placed as well with EVs growing and displacing combustion engine cars. And it has a supportive shareholder in Ping An, which is a big financial conglomerate in China. I'll just finish on this slide so we have time for questions, which is just the valuation of the portfolio. So
sorry, Gabriel.
Yeah.
You have until the end of that.
Oh, I have until the end of that. Okay, sorry. I thought that was the rest. Okay, I'll slow down. Apologies. Let me see if there was anything else to mention here. No, I think I covered it, to be honest. So in terms of the valuation of the portfolio, you can see that here. We tend to look 1 year forward in terms of earnings expectations, and you'll see that the fund is on 13, 14 times PE, which is a bit more expensive than the market. But we think that that's more than compensated by what we think are quality characteristics of the portfolio. So net cash, so debt to equity is negative. Profitability in terms of ROE is around 17% versus the benchmark around 12%. And it's not necessarily the highest yielding space. Asian small caps are more associated to growth, but we think 3% yield is actually not too bad for this space, and we think valuations are looking quite attractive at the moment. And actually on dividends, it is worth highlighting that the board last year doubled the dividend of the trust, and we've been able to cover that dividend quite comfortably through the income coming through the companies that we invest in. So even though it's been a difficult period macro-wise, our companies are actually delivering very good earnings and cash flow coming through. I was going to stop there, but I'll have some slides on macro and how we see the future. We don't like to crystal ball too much, but I think I'll spend some time on some of these slides. I think given everyone's very concerned about inflation and the outlook for growth, I think inflation in Asia has actually been pretty benign and has been surprising to the downside. That's unlike the Western world and also some other emerging markets. So I think this positions Asia well when rates start to come down. You actually have started to see across emerging markets central banks start cutting rates, although they're being a bit cautious because they're waiting for the Fed to act first. But that should be quite supportive for growth when rates start to come down. We see Indian corporates as being in a pretty good place. We can talk about the more macro and political side as well. But you do see Indian corporates with pretty healthy levels of ROE and comfortable levels of debt as well. And earnings expectations are pretty healthy as well, looking over the next year or two. China is a more challenging space at the moment. I think one of the concerns is just that the private sector and consumers are very unwilling to spend at the moment. So it's not a question of them not having the capacity to spend, particularly the households. They have saved quite a lot during COVID, and they're not borrowing much. So they're being very cautious because they are concerned about mixed signals from the government, regulatory crackdown. The property market's been weak, so that creates a negative wealth effect. But actually, consumers are actually in an okay space, and there is room for policy to ease. Whether that happens or not is an open question, and that is really down to one man. But there is space for easing in China, because in China there's no real inflation pressure. There's actually more deflation pressure at the moment. And it's one of these things that you have to wait and see. But it's a big market. There's lots of opportunity as well for growth in different sectors and pockets of areas where we quite like, which we can talk more about as well. Asia, we tend to focus always on China and India. But as I said, the trust has always had a big exposure to Southeast Asia. And Southeast Asia has been seeing foreign direct investment pick up. There is a pretty strong thematic at the moment around nearshoring and China plus one, where people are trying to diversify their supply chains, de-risk a little bit, not just because of geopolitics with China, but also because of the issues that COVID brought about in terms of you being too reliant on one geography is a concern. So you do see Southeast Asia benefiting from this. There's a bit of a race going on, I think, between governments trying to implement policy, structural reform that's most attractive to foreign firms. But I think you'll just see different pockets of business going to different areas. So I think we were in India in June, and they're trying to capture more of manufacturing as well from China. You see Vietnam already seeing a big boom in foreign direct investment over the years from Japanese and Korean corporates, for example. And I referenced strong balance sheets, and I think the corporate sector in Asia does have a much healthier balance sheet than Western companies. You see here the US and Europe versus Asia. Obviously, there are some pockets in Asia where there is leverage. So again, property in China, which we have no exposure to. Some Korean companies do have high debt. But in general, debt levels in Asia has been very low in the corporate sector, which again is something we like and I think helps with sustainability of these businesses. I won't spend too much time on this. I think I think the right-hand side is the more interesting one in terms of earnings expectations. Obviously, it varies a lot by market, but in general, I think the message here is that next year you still should see pretty healthy earnings growth coming from Asia. This year it's a very mixed bag, depending on which market you look. But again, we think the valuations are pretty attractive relative to history, relative to particularly the US. I think versus Europe and the UK, I don't think you can make as strong an argument anymore. I think Europe and the UK is also pretty cheap. But I think we do like the growth and characteristics and the macro outlook for the region. Finally, just allocation to Asia has been pretty low. So this just looks at global portfolios and how much they allocate to Asia relative to what it represents in the benchmark. And this is looking at large cap. So small cap, the allocation should be even lower, because I think not many people are looking at Asian small caps or emerging market small caps at the moment. So you see that over the last 10 years, we're sort of at one of the lowest levels in terms of allocation to Asian equities, which hopefully will, for us anyway, we'll see a recovery as people get more excited about the outlook there. This is just a slide on the characteristics of the portfolio. I think it's a bit of a summary of things that we've already discussed. Perhaps on the weighted average market cap, 1.2 billion market cap. These are really small companies actually in aggregate. So it comes back to that point about being quite different to other funds out there. This is almost like a micro cap fund in the context of other Asian portfolios out there. And I think I'd highlight these stats here in terms of capture ratios. It just means how much of, if markets sell off, how much you capture of it. We tend to be quite defensive, so when markets are weak, we tend to protect a bit of capital given that element of investing in more quality businesses. And this is the performance over the last 10 years. So again, versus the benchmark, we're pretty equivalent to the benchmark over the last 10 years. So that slide going back is a very long-term period, but we're very hopeful that we can continue to deliver outperformance, and total return is really what we're focused on. So we're not too bothered about benchmarks, but we're really trying to deliver a good absolute performance and good income for our shareholders. I'll probably stop there for questions.
Lovely, Gabriel. Thank you very much indeed. Thank you. Do you have any questions? As I said, please wait for my colleague to come over the microphone before you ask your question. Anybody want to get us started? Anyone feeling brave? Otherwise, I will. Can you talk about how much of the portfolio is focused on the domestic consumer versus the international, the export market?
Yeah, it's a good question. I think historically we've always been more focused on domestic markets, and also because of our greater exposure to Southeast Asia and India versus North Asia, that typically means that we're more exposed to domestic consumption stories rather than export stories. Having said that, we have over the last maybe 5 years increased our North Asian exposure a little bit. So you'll see, Korea, Taiwan, and China. Those are more export-oriented markets, so particularly Korea and Taiwan. So we do have some exposure. A lot of the exports are actually intra-Asia, so I'd say that the exposure to, we did have a look at revenue coming from the US and Europe is actually a pretty small portion of the portfolio. It's probably less than 10%. So it is, particularly when you think about small caps, they are more geared towards domestic growth and the domestic economy.
Another main question was about the portfolio turnover. You said your long-term holders. You showed some companies being held by Aberdeen for 26 years. What's the typical turnover in a year? And then the other part of that is, when do you sell a company?
Yeah, good questions. I think turnover is around 15-20%, so it is quite low. We had a period where it picked up a little bit about 5 years ago, where we our idea was to bring down the number of holdings, so we brought it down from about 80 to 50 to bring that concentration a bit higher into our higher conviction ideas. But yeah, generally it's around 15 to 20%. Second part of your question, sorry.
Your sell discipline.
Oh, yeah.
When do you sell?
Yeah, so it's always a case-by-case situation. I think obviously if the investment case remains relatively intact and it's just a question of valuation, we might just reduce the position rather than exit completely. We tend to exit businesses when we feel that the fundamentals of the business have changed completely. It's not what we invested at the start. Things are not going the way that we expected. But if it's more of a cyclical issue, we'll probably use that as an opportunity to add or to reduce a little bit. So yeah, I think with those companies that we've been held for 26 years or so, they've obviously been through some ups and downs. And we've probably been a little bit more active lately than in the past, but I'd say that turnover figure shouldn't go up more than 25-30%.
Okay. Question here, and then one at the back first here, please.
Thank you for your very comprehensive presentation. I've got two questions, really. It's been rumoured for some time that Vietnam would move from being a frontier market to a secondary emerging market. When do you see that potentially happening, and what impact would it have on your investment strategy and weighting? And secondly, if I saw the figures correctly as they flashed through, Korea was showing a substantial potential downfall according to analysts' estimates. I think minus 36% came on the screen, which compared to the other figures made my eyebrows twitch slightly. I see that you're exposed to 7.6% in Korea, and could reasonably argue, I suppose, that so long as you pick companies that are going up, why would you be worried about the market going down? But given that background, perhaps you could just give some thoughts on why Korea is suddenly not particularly popular.
Yeah, that's great questions. I think on Vietnam, I think it's the one frontier market that will probably get upgraded at some stage. The problem is there are still lots of accessibility issues for foreign investors. So the equity market has foreign caps on companies, which is normally a big issue for MSCI and the index providers, because it just makes it difficult for people to have liquidity and access to the market. Outside of that, just capital markets regulation in general in Vietnam is still quite poor. So I don't think that will happen anytime soon, but maybe within the next, say, 5 years, I think it could happen. I don't think it will change much how we allocate to Vietnam. I think we probably allocate more if we could find good businesses that are accessible. The best businesses in Vietnam that we found have full foreign ownership limits, so liquidity is really poor, even for us, which are, we're looking at small caps in Asia. So we have 2 positions in Vietnam. One is a property developer, and another is an IT services conglomerate. And the IT services conglomerate has done extremely well. The property company has been a bit more volatile, but they're both businesses that we're very comfortable with. There's a few in our pipeline that we might consider, but at the moment I think we're pretty comfortable with those two businesses. And it's a completely off-benchmark exposure at the moment, because it's not in our benchmark. If it were to enter, I'm not sure what the weighting would be, because then again, when China entered the large cap index, for example, because of also accessibility and foreign ownership limits, they enter with a cap and sort of factor inclusion weights. So I'm not sure what weight it would be, but it probably wouldn't be too far off where we are, I suspect. On Korea, you're absolutely right that the earnings are much more volatile, and that's really because Korea is a very tech-heavy market, and you've seen lots of volatility in the tech space. Korea is very well known for Samsung, so a lot of the equity market are either companies that supply to Samsung or businesses that are in the overall semiconductor or tech supply chain. And given you saw that big boom in tech during COVID, you've seen people build up inventory of everything that's electronic, essentially. And so in the last year or so, you've seen people digesting that inventory rather than buying more. So actually that's impacted Korean earnings this year. Where is it? Yeah, there you go. But you'll see a big bounce next year. And equity markets tend to look forward 6 months or a year. So actually you've seen a very strong rebound in Korea this year because people were saying, we're reaching the end of the destocking period. We are more positive on Korean equities going forward. For us, we have 3 companies in Korea. One is Park Systems, which I referenced, which is the largest company in the portfolio. That business has been growing 30% last couple of years, so it hasn't seen any earnings pressure. If anything, we're quite positive on the business going forward. The only area where a bit concerned is that the market is actually also expecting the company to do well. So that's where we need to be a little bit careful that the market's not getting a bit ahead of itself with expectations. And we have another 2 tech companies. So we struggle a little bit in Korea because governance for small caps tends to be quite challenging. They're normally founder-led businesses that are not very disciplined in capital allocation. So once they are successful, they start to allocate capital in different things and try and expand the business. Buy property, and for us it's very we've been burned a few times in Korea, so we struggle a little bit there to find good quality small caps, which is why we're quite underweight. It's one of the largest markets in the benchmark at over 20%.
When you're choosing your investments, do you start with the country allocation, sector allocation, or do it bottom up?
Totally bottom up. I think we spend a lot of time. We have a big team in the region, so our day job is really to meet companies and write research on these companies. And then we create a visit list, a pipeline of ideas that we like, and we keep seeing the same companies. We visit the market. So it's all bottom up. The first thing we start with is the quality of the company. Does it pass our quality test? And once it passes our quality test, then we think about valuation. So we tend to not just buy businesses because they're cheap. We do need to, first of all, think that they're great businesses to invest in. And then, I think portfolio allocation, then it becomes more of a debate about, do we have too much in this market? Do we need another company? Are we better off, just looking elsewhere for ideas?
And I think one final question.
Yeah, the growing political and military conflict between China and Taiwan, is that depressing your markets in Asia generally? And I wondered if it does become a hot war, how you might be able to make the funds more defensive.
Yeah, it's a very topical question at the moment. You know, some of our more liquid holdings are in Taiwan and China, so you know, if things started to escalate, we feel that we could sell down those positions relatively quickly. Obviously, liquidity would drop as well, so we need to be a bit sensitive. Our exposure to China is around 8%, and Taiwan is around 12%. If you include Hong Kong, that's probably around 20% of the portfolio in Greater China. You know, we don't really have any strong view on when a conflict or if a conflict might happen. Obviously, geopolitics and the tension between the US and China is only going one way, and it's here to stay. We think that this is a much bigger deal than Russia, so you know, it has much further implications than just for Asia. You know, if you think about a company like Apple, almost all of its supply chain is in China. So you know, a conflict there has really significant implications for US businesses, for luxury companies in Europe, where you know 30% of their revenue comes from China. So actually, in some ways, the Chinese local businesses might not be too bad from a local perspective. Obviously, from an equity market perspective, they might suffer. But you know, some of these businesses are localizing. You know, they have a big market to play in, that they're actually you know, insulated perhaps from a conflict. Taiwan is a more complicated issue, where obviously if there was a physical military on the ground conflict, infrastructure is destroyed, then that's something that would be quite painful for the businesses there. But again, it's got lots of repercussions globally from a semiconductor perspective, because you know, everything that we do electronically has something coming from Taiwan. So it's a big question. I don't know if we have time to cover in as much detail as it deserves. But you know, we try. You know, our mandate is to invest in Asia, so it's something that we're thinking about quite carefully with the board as well. We have a board meeting tomorrow. But you know, we still think there's plenty of opportunity in China and Taiwan, and you know, for the time being, we'll remain invested there.
That's terrific. Thank you very much indeed, Gabriel. That's really good. Thank you.